Time for personal finance at the Bauer College of Business at the University of Houston. Welcome, welcome. If you're on Facebook or the YouTube, welcome to the class. There's like twice as many people here today as there was last week. Where were you guys last week? You weren't here last week, were you? Oh, yeah. Cool. Well, it's good to see you. Ready to get started? We're going to talk about investing. Before we get started, I'm going to give folks on Zoom a few minutes to join. So if you guys have any questions, want to ask any questions, good time to do that. No questions? Hey, when does this semester officially end? Mid-May? Second week of May. So then we would be earlier than the second week. Oh, grades may go in after, but I'm not certain what the last official day is. I know when our course will be done. I usually get grades in before they're due. How you guys doing on your grades? Anybody concerned? Good, yeah? You doing the early assignments every week? Good for you. That's the best way to get those points. Okay.
You said
yes.
If we're getting full points on that, we should be with our participation, correct?
200 points, yes. Yeah, you'll get the full 200 points as long as you're keeping up with your class participation, those screenshots. And you guys have been doing a great job on that. So what will happen is if you miss assignments, then you'll get deductions on class participation. And if you're not putting in your class participation screenshots on your assignments, you'll get deducted on those assignments. So at the end of the semester, what I do is I look at your accumulated points and I try to figure out why you had deductions. And if it's for those reasons, I keep some notes. And then you'll get a deduction at the end of the semester. But I'm really not aware of anybody who's doing all the assignments who's going to get any deductions for that. So again, the key is if you're paying attention and you're watching on Facebook or the YouTube, if you're keeping up with your points, if you're keeping up with your assignments, you're going to be good on class participation. But if you've missed assignments and you just haven't done them, you will get a deduction on class participation. So even if you missed it and now it's late, you'll only get 1 point for turning in a late assignment. But that 1 point is there to tell me that you did the assignment. Does that make sense? So even if you missed an assignment and it's late, you want to do it because that 1 point tells me to not deduct from the 200-point class participation. All right. If you're missing assignments, it's never too late to go back and do them, but you're only going to get 1 point if they're late. Yes.
How much was you return it in time points?
Generally, I'm giving you 10 points extra if you turn it in by 3 o'clock on Friday.
Okay, because I got a 65 or 50.
You got a 65 or a 50? Which one did you get?
For the insurance assignment?
You got a 65?
Yeah, but the 50 was a max, and then I got 65.
Yeah, somebody was really nice to you. So I gave you 65. I did that for several students. And the reason I did that is I'm pretty sure you turned it in early, like the week that it was originally due. Did you?
Okay.
And so I tried to give you a couple extra points just to say thank you. But I changed the due date on that assignment because of spring break. I wanted it to sync up with the syllabus because that was brought to my attention that it was a different due date. But anyway, yeah. And sometimes I give even more points because you just go above and beyond. And so many of you have done that. Like I look at your articles and your reports and I can tell you put a lot of work into it. So I give you a couple extra points just to say attaboy. Overall, though, everybody's doing a great job. Really, I'm really impressed with especially this class. You guys, I appreciate that. Okay, it is now time to roll. So I am going to admit, I'm going to shut that down, and we are going to get started. So we're going to talk about investing today. And I'm going to cover 4 investment strategies that are designed to help you maximize returns and minimize risk. And what I want to do to start out is just to say that, there are a lot of investment strategies out there. And I've selected these 4 specific investment strategies because I know that these are the 4 investment strategies that are absolutely bulletproof in terms of helping you build wealth over your lifetime. So if you were my age, I'm going to be 60 next month. If you were my age, we'd be talking about a whole different set of investment strategies. But because of generally, I'm talking to you as students at the University of Houston who are typically younger than 30, some much younger than 30. You have a lot of time to invest. And these strategies are designed to help you maximize returns and minimize risk over time. And so they're, like I said, they're bulletproof. They absolutely work. I promise you, if you learn these 4 investment strategies today, when you walk out that door or turn off that screen, you will understand everything you need to understand to build wealth as an investor. And you will become a very fearless investor. You will not be afraid of market crashes. You will be encouraged to know that you're doing the right thing and that you have a plan and that your strategies are working for you. So I want to teach you 4 investment strategies designed to help you maximize returns and minimize risk. What they are, I'm going to tell you what they are. So I'll just tell you right now. Diversification, you've heard of it. It's number 1 strategy. It's very simple, and it helps you primarily avoid big risk, diversification. Number 2 is asset allocation. It's the single most important determinant of your portfolio's returns, asset allocation. So to understand asset allocation, I have to teach you a few extra things, which I'm going to do in a minute. Number 3, the third investment strategy is the most powerful investment strategy available to you, in my opinion. It's called dollar cost averaging. So I'm going to teach that to you with a story about Farmer Joe who buys cows. So that's coming up. That's dollar cost averaging. Another very common investment strategy, but I'm going to teach it to you in a way that you're going to understand it so that you can put it to work right away. And the 4th investment strategy designed to help you maximize returns and minimize risk is simply called portfolio rebalancing. So let's get started. I'm going to start with the market. When I say the market, what do you think of? The stock exchange? So did you know there's more than one stock exchange? What stock exchanges would you think of if I said the market? New York Stock Exchange. Okay. Anyone else? The market? What would you think of if I said the market? The market's going to go up, the market's going to go down. The market always goes up, the market always goes down. I just want to kind of highlight this term, the market. Some people think of the economy, and that's true. There are lots of markets, but you hear the market, that term, a lot. So I want to define it for you just so that as we talk about the market, we're on the same page. So do you remember what my favorite investment was? What was it? So that was the perfect investment. The 401k match is what I call the perfect investment. And I'm going to review that real quick. But I told you if I could only invest in one investment, because a 401k is technically not an investment, it's an investment, or it's a type of account. 401k is a type of account. The perfect investment is taking advantage of the company match in your 401k. But I mentioned my favorite investment of all time is the SPY. And the SPY, let me just show you what it is. The SPY is this right here. It's an ETF, an exchange traded fund, and it is when you buy. I'm looking at this chart and I'm noticing that it's going down. Can you see what this chart has done over the last several days? I mean, over the last 2 weeks, this big line right there, by the way, these are daily candles. Okay, what I'm looking at is a chart. If you're an investment advisor, if you're an investment manager, if you're a trader of stocks, you look at charts. So I'm just looking at a chart. This chart happens to be my favorite investment. It's called the SPY, and it's something I want you to know about because A, it's an ETF. It's an investment vehicle that's called an ETF, an exchange traded fund. And what that means is exchange traded fund. It's traded on the exchanges, but the SPY is a way for you to purchase the S&P 500. Does anybody know what the S&P 500 is? So the S&P 500, the Standard & Poor's 500, is an index. There are many indexes. There's the Dow, there's the S&P 500, there's the NASDAQ, and these are indexes. Okay, those are the three common indexes in the United States. The Dow is 30 big industrial stocks, just 30, not very many. I wouldn't pay much attention to the Dow. I don't. I try not to. The NASDAQ is like all the tech stocks, okay, like Apple and Amazon and Apple. Did I say Apple twice? Yeah, I did. Google, Facebook, all those tech stocks are in the NASDAQ. But the S&P 500, those are the 500 largest U.S. companies, which turns out to be the largest companies in the world, 500 of them. So when I say the market, that's what I'm thinking. Because those 500 company stocks will give you a good proxy for the market. In fact, the truth is, anybody that does what I do as a professional money manager, an investment manager, or even a day trader or someone who trades their own investments, everyone who's informed about this business of investing and trading, the number one most focused on index is the S&P 500. It's just the way the S&P 500 goes will tell you the way the market goes, okay? So just wanted you to know that. It's inside information, but it's helpful. The S&P 500 is something you need to know about. You know, you need to know what, when I say the S&P 500, you know that that's the 500 largest companies in the United States, which also is the largest 500 companies in the world. They're everywhere. Coca-Cola, you name it. I mean, they're the largest companies. So if I wanted to invest in the S&P 500, if I wanted to invest in the market, what's one way I could do that? I could invest in this one exchange traded fund called the SPY. So I think you should know about the SPY. Just have it on your radar. So if anybody ever says, hey, I'm buying the SPY, you know what that means. They're buying the S&P 500. It's my favorite investment. So if you look at this chart, if you look right there, what that is, that big green candle, you see that? That's the day that Russia invaded Ukraine. And the market started way low, but by the end of the day, it closed. It started out at like $410 per share. And by the end of the day, it was right around $428. It's a big jump in one day, right? But look at that chart from 2 weeks ago. What has the market done? What do those green arrows mean? It's rising. Look at all the days in a row that the market went up, up, up. Now my question to you is, if you had to bet $1, that red candle right there, that's today. So it was all the way up to the top, but what's it doing right now at the moment? It's decreasing. So if you had to bet $1, just $1, would you bet that the market is going to go up, down, or sideways today and tomorrow? Just notice that the market always goes up and the market always goes down. Over time, like if we were talking 5 years from now, I would say the S&P 500 is definitely going to go up. It always goes up over time, but not over short times. So after that many days up, if I'm looking at that chart, I'd have a pretty good guess of what it's going to do. But I'm curious, what do you think? Just from what you know so far, what do you think the market might do? Yeah. Yeah, so just something to think about, I just thought it was kind of interesting. So we've got the S&P 500, that's the SPY, and then the Qs, that would be the NASDAQ, and then the DIA, that would be the Dow. ETFs, they're exchange-traded funds. If you wanted to buy the market, you could buy one of those and you'd be in the market. You could buy all three of them and you'd be in the Dow, the NASDAQ, and the S&P 500. Does that make sense? So that's just a quick lesson on the market. And when I say the market, that's what I'm thinking, the S&P 500. So that's that. Just wanted to go over the market. Now I want to quickly go over 5 investment vehicles because I want to make sure you understand different types of investment vehicles. I'm going to talk about investment vehicles, and then I'm going to talk about asset classes, and next week we're going to talk about types of accounts, okay? So types of accounts, when we talk about tax-advantaged investing, the second law of personal finance is the law of tax-advantaged investing. The IRS makes the rules. Your job is to take advantage of them. And one of the ways you do that is by the type of account that you invest in. So last week I told you about the perfect investment. And it's really, I had to say then and I have to say now, disclosure, legal notification, there is no such thing as a perfect investment. But if there was, it would be the company match that comes with your 401k. So last week I gave the example, the illustration. I said you're making $100,000. You work at Shell, and Shell offers an 8% match. So day one, when you sit down with HR and they ask you to fill out a form about the benefit package, when you get to the 401k, your answer is going to be yes, and at least 8%. So not only are you going to say, yes, I want to participate in this 401k plan, but you're going to be smart enough to know that the company has a match, and the match is 8%. So you're going to know quickly how much you want to contribute to your 401k so that you can get the match. So the illustration was you make $100,000 a year. You work for Shell, and Shell is paying an 8% match. So how much are you going to contribute to your 401k in the first year? $8,000. You're just going to set that up so it comes right out of your check and goes right into your 401k. At the end of the year, how much did you put in? $8,000. At the end of the year or throughout the year, how much does the company contribute? $8,000. They contribute up to 8% of your income as long as you contributed that 8%. If you don't contribute, neither do they. So that's the perfect investment. And that happens inside of a type of account. It's called a 401k because that's the chapter heading in the IRS code, 401k. It's a paragraph. And that's where the rules, boundaries, and limitations are outlined in the IRS code related to that type of account. So next week we're going to talk about types of accounts, but I just wanted to set the table and help you understand because there is a quiz and it is on the quiz, that if I asked you about types of investments, and one of the answers is Roth IRA, is that a type of investment? No, it's a type of account. Just know that. Be smart enough to know the difference between an investment and a type of account. Okay? The 401k is a type of account. Inside of that, there's some things that are happening. Because of the type of account, it allows your employer to give you a match, which gives them a tax deduction. But it also gives you a tax deduction. So if you contribute $8,000 to that 401k, at the end of the year, when you file your taxes, the IRS is going to see that you contributed $8,000, and so instead of making $100,000 and paying taxes on $100,000, how much do you pay tax on? $92,000. That's the second big benefit of the perfect investment, is you actually pay tax on less than your whole income because your 401k gives you a tax deduction. Because that's part of the rules and benefits of that type of account. So you're going to learn more about types of accounts and the benefits that they have, and you're going to work that into your financial plan moving forward. But I just wanted to set the table before we get into these 4 investment strategies to highlight that there's a difference between an investment and a type of account. And then there's a difference between investment vehicles. And that's what I want to cover real quick. So one of the investment vehicles that I want to talk about is a company stock. Does anybody know, when I say a company stock, what do you think? Yeah, ownership of a company, shares of a company's stock. It's a way for you to invest in that company, and if they do well and their stock goes up, you gain, you benefit, you have a return on your investment. So an individual stock is one investment vehicle. You can invest in stocks, right? We're going to talk about asset classes in a minute. But before we talk about asset classes, let me just ask you, what do you think when you think of stocks? How many different kinds of stocks do you think there might be? 2? What 2? Common and preferred. So that's a great answer. That's beyond the scope of today's lesson, but that's a good answer. So if we talk about the S&P 500, if I said, what type of stocks are they? What asset class would you think the S&P 500 is? Are they big, small, medium? The S&P 500 is huge. Each of those companies, they're the biggest companies in the world. So they're large cap. That's what they're called. And there's an article, in fact, there's tons of information in your money study group. You do not have to learn it all. It's there for you if you want to learn more about investing. And one of the articles I posted has to do with market capitalization. But when we talk about stocks, when we talk about asset classes, we have to distinguish between a big company and a small company or a mid-cap company. And they call it cap, large cap, mid cap, small cap. That's an asset class. What do you think it means? Large cap, small cap, mid cap. If the S&P 500 is large cap, what does that mean? Yeah, they're just big. They're like huge. So they qualify as large cap because, in fact, the S&P 500, that asset class would be U.S. large cap. What other kind of large cap might there be? How about China? Does China have any large cap? Yeah, a lot of different countries, the UK, Australia, a lot of countries have really big companies, and they would be classified in terms of an asset class as large cap. But U.S. large cap is a classification. And if it's a small U.S. company, it would be U.S. small cap. If it was a mid-sized company, U.S. mid-cap. Okay, those are classes, asset classes. It's important to know that for what I'm about to teach you. But start with an investment vehicle, it's a stock. you can invest in a stock. You can invest in a small stock, a large company stock, a mid company stock. It's a stock. Okay? And yeah, there's preferred and common, but typically when we're investing as regular investors, we're buying common stock. So that's a stock. What other kind of investment vehicle do you think might come next? Anybody know what a bond is? Do you know tell me what a bond is.
You essentially give a loan out to a company or to anyone, and they pay you back in interest,
So,
and eventually give your money back in a later date.
yep, good. So if I buy a bond, I'm basically giving that company, I'm loaning them my money, my cash. They're paying me a premium. They're paying me a distribution, a coupon. They're paying me interest on the money that I gave to them. So it's different than an investment. It's an investment, yes, but it's different than a company stock, even though it could be a bond from a company, right? I could buy stock in Apple or I could buy a bond, right? Apple has bonds. Do you think so? Bonds are an asset class. And if that's true, what do you think might be some sub asset classes underneath of bonds? Like who issues bonds?
Anything.
Any company can issue a bond to raise money. Who else issues bonds? Government. So the U.S. government bond would be a specific asset class. U.S. government bonds. What other U.S. bonds might there be? U.S. corporate bonds, like Apple would be a U.S. corporate bond. If the company's in China, it could be a Chinese corporate bond, right? Or China could issue its own bond and it would be a Chinese bond, right? So bonds, just like stocks, have subcategories underneath it that make them different asset classes. But a bond is different than a stock. So that's another type of investment vehicle is a bond. And I don't expect nor even really care for you to become an expert. I just feel like it's my duty as we get into investing to highlight these different investment vehicles. So I'm going to cover 5: stocks, bonds, mutual funds, index funds, and exchange traded funds. I'm going to cover those 5 here briefly. The first one we already talked about, stocks, bonds. Now we get to mutual funds. Does anybody want to take a stab at telling me what a mutual fund is, if I can? And you'll see this again in Money Study Group. There's a lot of information. You don't have to, you're not going to be tested on it. It's there just for your reference. I hope if you want to learn about investing, it's helpful information. Mutual funds. What's a mutual fund?
I don't know what the difference between a mutual fund and an index fund is, so I could be defining one or the other. But a bunch of companies, like I guess you could say the S&P 500, and then you buy into a small, you say like, here's $100, and they give you $1 out of each of those large companies. So that's like really diversified.
So that's right. You mentioned diversified, which is one of the keys. Mutual fund was invented quite some time ago, before index funds. And you mentioned you weren't sure about the distinction between a mutual fund and an index fund. And I want to make sure you know that, because to me, that's what makes a mutual fund a mutual fund. Yes, you have a diversification because a mutual fund includes a bunch of different stocks or bonds or stocks and bonds, and depending on the mutual fund, what type of mutual fund it is will determine what types of asset classes are inside of it. But the point is, you get diversification when you invest in a mutual fund. You also get a manager, which means a mutual fund has a manager, somebody who's picking and choosing the investments inside of the mutual fund. So that's a mutual fund. And the difference between a mutual fund, and by the way, so this is an illustration from my friend Taylor. Taylor, again, I hope you're doing well. This is one of the illustrations in my book that I use to illustrate diversification. my friend David Coney at Edward Jones, he taught me a lot about investing, and mostly he taught me about communication and how to communicate these principles. And the way he did it was he said, okay, diversification is like if you go into an old building and you get on an elevator. If you get on that elevator and it's got one cable, how safe are you? It's a very old elevator, and the elevator, the very old building, very old elevator, and it's got one cable. That's like what you get when you invest in one stock. If that company management starts to deteriorate, if that competition for that company gets greater, if something happens with the price of commodities that company has to buy, so many things can make that company's stock go down. So that's the elevator on the left with one cable. A mutual fund, on the other hand, has a manager who selects and inspects all of those cables to make sure that the best companies that they can find are in the mutual fund. So theoretically, a mutual fund manager is putting companies into the mutual fund that, will make it not just more diversified, but have better performance. The truth is, though, that doesn't happen most of the time. Most mutual funds don't do better than the market. And when I say the market, what am I thinking? The S&P 500. That's what I'm thinking. So most mutual funds don't perform better than the index they're trying to, stick to. Then after mutual funds comes index fund, the different investment vehicle. It's an index fund, and the difference between an index fund and a mutual fund. Sorry, I got to scroll down to index fund. This is a very long article, so it's not much of a helpful picture, but an index fund is just like a mutual fund, except there's no manager. So when you have a mutual fund, what do you think you have to pay for the manager? Do you think that's free, or do you think, well, not a percentage of your earnings. They charge a percentage right off the top. So even if you don't make money, even if you lose money in that fund, you're still going to pay the manager fee. And you're also going to pay some marketing fees. There's a lot of fees in a mutual fund. So the difference, the reason that an index fund was created was so that you could buy the index. What's an index? The S&P 500 is an index. So if you want to buy the index, you could buy the SPY, which would be an exchange-traded fund, but we're not there yet. We're talking about index funds. So you could buy an index fund that is a proxy for the S&P 500. And it's just like a mutual fund, except instead of a manager selecting the best of those companies, buying and selling them, you're just getting the entire index. And that's why index funds became very popular, because you cut out the manager, which meant you didn't have an extra fee for that. You still have fees in an index fund, but they're a lot lower than a mutual fund because they're just investing trying to track the index. So if you bought an S&P 500 index fund, you're basically buying all 500 of those companies in this one fund. Is that boring? Oh, look, you guys look bored. I know, it's boring, but it's important. So that's what an index fund is. Now, a mutual fund and an index fund, they trade the same way, which is different than a stock. When I say trade, I'll show you what I mean in a minute. I'm going to show you now. So let's say I'm looking at the S&P 500. Man, do I want to buy it or sell it? Buy it or sell it? I'll tell you what. Let me look at the day that Russia invaded Ukraine. So let's say that I had $100,000 sitting around and I'm watching the market, because the market has gone down, down, down. I don't know if you can tell by that chart, but the all-time highs are off the chart. Okay, and somebody who's a smart trader might have said, okay, I'm going to sell while the market is at all-time highs. I'm just going to put my money in cash and I'm going to wait for a better opportunity to buy. right? So let's say I'm that guy and I got 100 grand and I want to buy the market. My favorite investment would be SPY. And so this is the SPY. And this day right here is the day that Russia invaded Ukraine. And let's just say that in the morning I wanted to buy the S&P 500 at $410. So I put my order in, and guess what price I get for the SPY? I buy it at $410 a share. So if I'm putting $100,000 in, I'm buying all those shares at $410. And what if I sit back and I go, man, the market went up a lot. By the end of the day, let's say I go, man, I made a lot of money today. I'm going to go ahead and sell it at the end of the day. That's called day trading. So let's say I did that. Would I make money? Yeah, I would have made a lot of money, right? Now, on the other hand, let's say you were investing in a mutual fund, and it's me, the same guy. Instead of buying the SPY, I bought a mutual fund. What's different about that? Let's say that the mutual fund manager is really good at picking stocks from the S&P 500. It's basically an S&P 500 mutual fund with a manager who's charging a fee to pick the best of the 500 companies. And so I buy that mutual fund. What happens when I put that order in at 9 o'clock in the morning when the market is down?
Well, like you wouldn't feel it's like that's an average, right? So you could possibly buy Apple or something that tanked that day.
Right. But instead, I want to be diversified. I don't want to buy one stock. I want to buy the market.
You could buy like Apple and then Amazon
No,
and
though.
else, right?
No, think about it. I'm saying we're looking at three different investment vehicles. I'm not buying a stock because I want to have diversification. I'm not buying a bond. I'm looking at the market. The market's down, so I want to get in. I have three choices: an ETF, a mutual fund, or an index fund. If I buy a mutual fund in the morning, what price am I going to get? This is the big distinction between an exchange traded fund, a mutual fund, and an index fund. And it may not matter to you, but I want you to know what it is. It's the reason that guys like me who manage money professionally really like ETFs, because they trade like stocks. And when you buy a mutual fund, you put your order in the morning because the market's way down. It seems like a good day to buy, but if the market has a 10% pop up, you're getting the end of the day price for a mutual fund. So I don't know if you knew that, but it's a big deal if you're a trader, and if you're managing a professional portfolio. You want to be able to get in and out when you want to get in and out. With a mutual fund and an index fund, they trade at the end of the day price. So, and usually there's a fee to trade them. But that's a big difference between mutual fund and index fund. They both trade at the end of the day. So even if you put your order in the early morning when the market's way down, you're getting the price at the end of the day for wherever the market is. As opposed to if you're buying a stock or you're buying an ETF trades like a stock. So if you buy it when it's down in the dumps, and if the market goes up at the end of the day, you make money that from the time you buy it in that day to the end of the day. That's just something I wanted you to know. So, is the S&P going to go up today or down today? Should we sell it or buy it? So that's an investment vehicle. So I just wanted you to know the distinctions between a stock, a bond, a mutual fund, an index fund, and then finally the ETF, the exchange traded fund. Exchange traded fund is by far superior to a mutual fund and an index fund because you get the diversification that you would in an index fund. You pay no fee for a manager. In fact, the fees on an ETF are way lower than an index fund. The S&P 500, the SPY, it's like 10 basis points. That's the fee. That's nothing. Most mutual funds you pay between like 1.25% to sometimes up to 3% or 5%. And then you have other fees. There's tons of fees in a mutual fund. So that's what I wanted you to know, is just understand what these investment vehicles are and how they work. When you get to do your 401k, your company is going to determine what type of investment vehicles you guys even get to use. It'll probably be index funds. So you won't be able to trade like a stock, which is fine in a 401k, but I just want you to understand the difference between the investment vehicles. Yes, sir.
Repeat that, the percentages for US and the basis points and whatnot.
Sure. So when you invest in a mutual fund, you're going to pay fees. Because it has a manager, you're paying a lot more fees than you would if you were in an index fund. You may have a mutual fund that basically invests in the S&P 500, but that mutual fund manager, he's always looking for the best companies and he's buying and selling them, trying to make money. So you're paying a fee for that. And that fee may be 1%, maybe 2%, maybe 5%. I sold mutual funds for State Farm. It was 5% load, 5% fee, 5%. And that was the middle of the road. So retail funds, mutual funds, have fees, and sometimes they're pretty high. An index fund will still have fees, but they don't have a manager. So instead of paying 1 or 5%, you're probably paying 50 basis points. 50 basis points is half of 1%. Okay, that's what a basis point is. But on an ETF, like the SPY, you're getting the same diversification. You're getting all of the S&P 500, and you're paying only 10 basis points. And it trades like a stock, meaning you can buy it, you can sell it, you can do options with it. Options is beyond the scope of this course, but trust me, if you do what I do for a living, you don't want to mess, typically you don't want to mess with mutual funds or index funds. ETFs are by far superior, in my opinion. Does that make sense? So those are the 5 investment vehicles. There may be a test question on the quiz. I don't think there is this week, but you need to know those 5 investment vehicles. Any questions? I'm starting to lose my voice again. So somewhere we talked a little bit about asset classes. I'm not going to go into that too much, but do you guys understand what an asset class is? If I say asset class, you could have U.S. large cap, that's an asset class. Small cap, small company, that's an asset class. Just remember that asset classes are really important as we get into asset allocation, because that's what you're allocating, is asset classes. All right? I feel like I'm losing you. Okay, here we go. You guys remember Enron? What do you know about Enron? Enron was a big story. It's the story that I tell when I want somebody to understand the importance of diversification. Diversification helps you prevent risk. It's not so much a way to gain, but if you're preventing a loss, you're basically improving your returns, okay? But diversification is the most simple, basic investment strategy there is. But it's really important. And Enron is the story that helps highlight how important it is. So I had 2 clients, one man, one woman, both worked at Enron. They both made a lot of money. They're in middle management. And her name was Andrea. She was smart. We had a conversation, and I helped her understand that diversification was important for her because investing in Enron, the stock was doing what? Enron stock just kept going up and up and up and up. So everybody in the company who had a 401k there, they had the option of putting all their money in their 401k in Enron stock. And it made millionaires, lots and lots of millionaires, right? Because the stock just kept going up. It's my phone ringing again. Good. It's vibrating. So Enron Andrea, we had a conversation, and she decided instead of putting all of her money in the Enron stock, she decided to diversify. So we put it in the S&P 500 and some tech stocks, and we just diversified her whole portfolio. She was making a lot of money with Enron. So my point was, if you're getting your income from Enron and your retirement plan is in Enron, that's not very good. That's not diversified. Does that make sense? You're putting all your eggs in one basket. So that was not a good idea. And she trusted me, and we made some changes. But Bill, on the other hand, he was in a similar situation. He was putting all of his 401k in Enron, and he worked at Enron, and he was getting to the point where he wanted to retire. He had well over $1 million in his 401k, and he was doing great, but he liked seeing that account balance go up and up and up. And then the fit hit the shan with Enron, and it started to collapse. And do you know what these people at Enron were telling their employees when their stock price came down? They told him, this is the best time to invest in Enron. You've never had this good of opportunity to invest in Enron. So Bill believed them. He was a company man. He went out and took a equity loan on his home so he could put more money into Enron stock. And what ultimately happened with Enron stock? It went away. It turned into a penny. I mean, it just disappeared. And Bill's account and his income disappeared. And his wife became a widow because his stress level went so high. He had a heart attack, and he literally, because of stress, losing money, that kind of money will make you very stressed, especially the older you get. And it was very hard on Bill, and it ended up...
Should he have taken it out sooner before it did collapse?
Yeah, he should have done the same thing Andrea did. She took her 401k and she went in and pushed a few buttons, and she said, I'll buy the S&P 500, I'll buy the market, I'll diversify, I'll move it around. That's what she did. That's what I advised her to do, and that worked really well for her. She still lost her job at Enron, so she's still, she's making a couple $100,000 a year, and that's gone. But she was able to get another job, and she had plenty of money stashed away so that she had a huge emergency fund. She was in good shape. Bill, on the other hand, because he did not follow this one strategy, it ruined him financially, physically, mentally. I mean, he died as a result of his stress. And his wife worked with my wife. My wife was a teacher at the time, and she became a teacher's aide. She had no skills. She'd never worked in corporate America, but she had to have a job to buy groceries. They went from living in a big house with a lot of money to she's a widow now, and she's having to work making basically minimum wage. This is a hugely important principle about investing, and it's one of the reasons, it's one of the 4 strategies I want you to know, is diversification. You do not want to put all your eggs in one basket. I don't care how good the investment is. Think small, invest a little bit, part of your assets, and don't put everything in that one investment, especially if you work for the company. If you start a company or you partner with somebody that starts a company, don't just invest in that company. Invest in other things as well. Diversification is key. Does that make sense? So that's the first strategy. The first strategy is diversification. Now, if you Google the word diversification, you're going to get a whole bunch of people talking about something that's similar to diversification, but it's really asset allocation. Diversification is super simple. It's don't put all your eggs in one basket. But people talk about diversification as if it means something more than that. And the more than that is really asset allocation, which is the most important determinant of your portfolio's returns. So if you have good asset allocation, you will have diversification. Because if you allocate your assets across all these different asset classes, you are naturally becoming more diversified. But the opposite isn't true. You can have diversification and have terrible asset allocation. So they're two different things, is all I'm saying. And asset allocation is important because different asset classes respond differently to market forces. So typically, when the stock market's going up, bond prices are going down. And typically, when the stock market's crashing, what's happening to bond values? They're usually going up. Bonds are usually where people put their money when they're afraid, especially U.S. government bonds. So now there's a lot more to it than that. If you understand how interest rates work, you know that when interest rates go up, the value of bonds go down. And lately we've had interest rates going up and the price of bonds has really gone down. But there's coming a time, I'm sure, when the market's going to have a pullback or a crash, or fear will be in the market and there will be a lot of money going into bonds, which means that that asset class will go up even though it's down right now. So commodities, when I say commodities, what do you think of? Does anybody know what a commodity is?
I thought that was like luxury or something.
No, a commodity would be like pork belly or oil or gold or wheat or sugar. These are the things, commodities like steel. These are the things that are inputs, the things that every company has to have to manufacture stuff. So commodities are like the bare essential things that go into everything. And you can buy commodities. They're an asset class. One asset class you could be investing in right now is energy or oil. Does anybody know what the price of oil has done? Why? A couple of reasons, but oil has gone way up. But in 2020, the price of oil was so low. In fact, there was 1 month when futures contracts for oil were trading for negative $40. It was the most insane thing I've ever seen. It's a complicated thing, but the problem then in 2020 was there was so much oil and nobody was using it because of what? Because of COVID. There was so much oil on the planet that they didn't have a place to store it. So they were having to pay huge prices to store it on barges and anywhere they could store it. So the value of oil was actually negative. Can you imagine? Now, at that point, that commodity, that asset class was in the commode. It was so low. I was telling all of my clients, this is the best time ever to buy oil. I mean, if you can buy it that cheap, right? Because gas was like $1.30 a gallon. And I was just saying to my clients, how long do you think gas will be $1.30 a gallon? So asset classes, that's what they do. Different asset classes go up and down at different times. And that's why asset allocation is so important, because you want your investment portfolio to have a good percentage, the right percentage of each and every different asset class. You want to have oil in there, right? Today, oil's trading off the charts. Well, it's actually started to pull back. But because of the invasion in Ukraine and because of the supply and demand and the production of oil, there's lots of reasons that oil as a commodity became very, very expensive. So it went from very, very, very cheap to very, very, very expensive. That's what,
Is it gonna be cheap again?
I don't know. But it will be cheap again at some point, but I don't know when.
The gas prices in Cali are like $8 right now.
$8 a gallon. And they're giving $400 a month per registered vehicle to each and every registered vehicle. Maybe they are not doing that. Maybe that's in the legislature. But Governor Newsom was going to do like a, gas help the people bill. So yeah, it's crazy. So I just want you to understand, asset allocation, it's an investment strategy. you're going to need to understand that asset classes are what make up asset allocation. Stocks, bonds, real estate, commodities, the precious metals. There's lots of different asset classes. But that's what we mean when we talk about asset allocation. And it's the single most important determinant of your portfolio's returns. So just get to know it. Just be familiar with what it means. I don't expect you to be an expert. Now I want to talk about what I think is the most, yes.
Sorry, earlier, I had a question because earlier you mentioned that, I forgot her name, but that, she took her, 401k.
Yeah,
And,
Andrea at Enron.
and that, she put it in like different, well, she invested in it, right?
Yeah, we built a portfolio that had good asset allocation that was diversified and spread out over different asset classes instead of one company, Enron, like Bill did.
Yeah, so my question is that, so does that mean that she borrowed from her 401k to increase?
So, good question. Did she borrow from her 401k to increase and diversify? And no, what she did is she did the same thing you would be able to do if you had a company 401k. You have selections. You can tell your 401k where you want to invest. So you have different options. One of the options a lot of times is to invest in your own company. And that's a good thing, but you want to do that with a small amount, unlike what Bill did. He wanted to put everything in his company. So you can do that in some 401k plans. You can invest very heavily in your own company, or you can push a button and you can pick other investment opportunities within your 401k. So you're just moving it from here to there inside of that account.
Generally, with those potential assets that you could change or choose to invest between, would they only be of a certain class, like stocks? Or could you say I want to invest in real estate with my 401k?
That's a great question. So the question is typically in the 401k, how many options do you generally have? Or are they very limited? And the answer is they can be very limited, but typically they have at least stocks, bonds, usually real estate, and depending on the company, you could have a lot of options. Some companies just give you a few options. It's all about the cost and what is the company willing to pay to set up a 401k plan that gives their employees the benefit of selection.
But who's managing that? Are you choosing the stocks that you're buying?
You generally don't buy individual stocks in a 401k. You can do that in your own accounts, but not in your 401k. So in a 401k, generally you're going to have like index funds or mutual funds or ETFs. Some have ETFs, but not individual stocks, other than your own company stock. It's like that they let you buy your own company stock, but you can't buy Apple in your 401k, typically. Now, there are some 401ks that are very creative for smaller companies, but typically you're going to have plenty of options in your 401k and to be diversified and have good asset allocation. They give you enough options to do that, typically.
Is the index fund, would it be the NASDAQ or something?
Could be. There's a lot of different indexes. So you can get an index, you can get a precious metal index, a commodity index, there's a real estate index. So they could be an index fund for any of those indexes. The three common ones are the Dow, the NASDAQ, and the S&P 500. And again, I think I showed you the tickers that you could invest in to instantly buy those three indexes. The SPY would be the S&P 500, the DIA would be the Dow, and the QQQ would be the NASDAQ. And those are ETFs that give you instant diversification within an index. But that's different than good asset allocation because good asset allocation spreads you out across different asset classes. So if you buy the Dow and the S&P 500, you have no exposure to small cap. So let me ask you this. Do you think there's more opportunity in a small company investment or a large cap? Why is that?
because your money goes further, your return would be probably higher because they have margin for growth.
So the answer is there's more opportunity for growth in a small cap, which is true. Small company has a lot more growth, which means a lot more opportunity for returns. But what also comes with a small company as opposed to a large established company? Less security, more risk. So that's why these asset classes are important. You want to have those blue chip S&P 500 companies because they're solid, they're secure. Over time, they're going to go up. But you also want to have some small caps and some mid caps and some international. Those are all different asset classes that make up asset allocation. And again, asset allocation is the single most important determinant of your portfolio's returns, to have it spread out over all those different asset classes. And generally, you get those options in your 401k. So when you sign up for your 401k and you say, yes, I want to participate, and yes, I want to contribute all the way up to even more than the max, the match. I mean, you could do more than that, but at least do that. And then the next thing you have to do is say, where do you want to invest it? So when you fill out that form on day one with HR, just on that one section, you're going to have to say, yes, I want to participate in my 401k, and this is how much I want to contribute based on the match. And now you have to say, where do I want to invest it? And it should be pretty easy for you to look at your options and be able to go, oh, okay, I know I want to have 25% in U.S. large cap, 25% in bonds, 25% in small cap, and 25% in international. And I'm going to just set it up that way. And every week that I get paid, I'm putting money into that account. I'm putting, if let's say you set it up the way I just said, 25, 25, 25, and 25, and you're putting $100 per paycheck into your 401k. That means you're putting $25 into each of those different asset classes, right? Automatically. That brings us to dollar cost averaging. I want to make sure you understand what dollar cost averaging is, because what I just described in your 401k, dollar cost averaging, is the most powerful investment strategy available to you, in my opinion. Here's how it works. So I had a client named Joe. He was a farmer, but he didn't have any cows, and he wanted to diversify. He thought, in terms of investing, a farmer should have a good diversified portfolio, right? Chickens, pigs, vegetables, you name it. But he didn't have any cows. So we talked about a plan. We put together a plan. He decided he was going to invest $100 a month. So we set up a dollar cost averaging plan for cow purchases for Farmer Joe. When we got started, how much is he going to invest in cows? $100. How often? Every month. So he's going to do a plan, $100 a month, and he's going to buy cows. The first month that he buys cows, this is a chart. I'm sorry about all the notes. I thought I had the one without notes, but the first month, this is the first month, and cows are $100 a head that first month. So how much do you think, how many cows did he buy? Yeah, one. This is very simple. I like simple math. So month number 2 comes along and the price of cows goes down to $50 a head. How much does he invest? $100. How many cows does he get? 2. This is dollar cost averaging because the price of cows went down. His investment plan stayed the same. Dollar cost averaging allowed him to buy 2 cows. The next month, cows jumped down in price again by half. So now instead of $100 a head, not $50 a head, they're half of that. They're $25 a head. How much does Joe invest this month? Month number 3, $100. How many cows does he get to buy? 4 cows. Okay, good. You guys got it. Now, the next month comes along. This would be month number 4, and cows go all the way down to $20 a head. How much is he investing? $100. How many cows does he get to buy month number 4? 5 cows because they're $20 a head. And that is when Joe called me, and he was pretty upset. He's like, Munchback, why did you get me into buying cows? This is crazy. The price of cows has done nothing but go down, down, down. Sell my cows and get me out of the cow business. And I said, wait a minute, Joe. That's the absolute wrong thing to do right now. Instead of selling your cows, you should sell your John Deere tractor, because you bought that a few years ago, and because of the supply chain stuff, you can now sell your used Deere tractor for like 20% more than you bought it new. Did you guys know that? Yeah, Deere tractors that have less technology on them today, that don't have chips, because farmers can actually fix those, they're worth a lot more money. So I'm like, Joe, that's going to change. Sell your Deere tractor and buy more cows, but at least don't sell your cows. Does that make sense? So he bit the bullet. He said, okay. The next month, cows go back up to $25 a head. How many does he get? 4. Yep. Then they go back up to $50 a head. And he gets to buy how many? 2. Thank you. I'm sorry. It's so boring. Then finally, month number 7, cows go all the way back up to where they started, $100 a head. He invests his $100 and he gets 1 more cow. And that's when he calls me again. He says, Jim, look, I think I want to get out of cows. I really thought about it. I'm like, okay. So we decide we're going to put the order in. We're going to sell his cows. How many cows has Joe purchased for the last 7 months? A lot. That's the most common answer I get. He bought a lot of cows, but that's not the right answer. There's a number. Let's count them. First month, he bought 1, then 2, then 4, then 5. So if you can do easy math, how many cows is that? I'm going to count them. Thank you. 19. And how much did Joe invest each month? $100. How many months? 7 months. So how much did he invest? And when he sells the cows, 19 of them, for $100 a head, how much is he going to have in his account? $1,900. So if he invested 7 and he has 19, what was his profit? $1,200. That's the power of dollar cost averaging. Cows never went over $100. They had a terrible downturn like oil did, and then they went back up to their all-time high, and he sold them. And dollar cost averaging allowed him to be an investor through the worst cow market in history. And it worked out really well for him. And it'll work out really well for you. If you put this strategy into practice in your 401k with the asset allocation that you have set up with 25% in large cap, 25% in small, 25 or however you want to do it, you follow that? Now, every time you get paid, a part of your paycheck is going into those different asset classes. Think of them like chickens and cows and, wheat and whatever. They always go up and down, and you're going to be systematically investing using dollar cost averaging. It's the most powerful way to build wealth over time. Does that make sense? Any questions? Yes.
Does this generally only work with something like the industry that consistently does go up and down or rises?
Everything goes up and down. Everything you could invest in goes up and down. So it works for every asset class. Yeah, every asset class. Remember, you're not doing this, you're not buying stocks this way. You're buying ETFs or mutual funds or index funds. And you're buying little pieces of them in your 401k. That's how this will actually work in real life for you. And because your 401k allows you to have money come out of your paycheck every time you get paid, parts of it go into these different assets that you've allocated, right? You're doing the same thing Farmer Joe did. So when you see the market pull back or crash, you don't need to be upset. You need to be going, oh, I'm so glad I'm doing this. And the longer the market stays in a crash, the better for you, because you keep putting your money in and you're not taking your money out until you retire, and you're giving it a long time to come back. So does that make sense? So again, these strategies are designed for younger people. If you get to be my age and you want to pay attention to, you don't just do this until you're 60. As you get older and you accumulate more assets, you need some different strategies. So different strategies that still include asset allocation, but you're being a little more tactical. But for the next 20 years, you can do this and you will make money. Because the next one I show you is important too. The fourth and final investment strategy designed to help you maximize returns and minimize risk is called portfolio rebalancing. So if you looked at that chart, and let's say that that's your portfolio, and let's say that one of the things you allocated your investments to was oil, which one of those pieces of the pie do you think would be oil? Probably the big blue one right now. Oil has gone really high. So if you said I want, because you're in Houston, you understand the oil industry. Let's say that part of your investment strategy, one of your asset classes was you were going to invest in something that was like an ETF for oil, like the OIH. Let me show you the OIH. If you wanted to invest in oil, you would invest in oil services. You would invest in an ETF called OIH, if I can only find it. Most of them, yeah. Some of them are individual stocks. So this is an ETF. You're buying companies like Schlumberger, Hess. I'm trying to think. There's a bunch of companies in here. I'm not going to show you, but this is an ETF. So let's say that you bought, because you knew oil was going to go up, and you bought that, and let's say that you started with 10% of your portfolio was in OIH, right? But now it's grown to that because it's just gone up, up, up. So portfolio rebalancing is a systematic way every quarter, every 6 months, at least every year, you want to go in and rebalance your portfolio. So oil should have been 10%. So basically what you would do is you would sell off everything except 10% and rebalance your portfolio. And where would the money go? If you sold that, if that's your portfolio, and you were going to decrease oil, what do you think that small piece of the pie might be right there? Exactly, bonds, because bonds have gotten cratered. So now when you rebalance your portfolio, you're taking your profits from oil that's gone way up, and you're going to take that profit and you're going to get bonds back to the 20% or 25% that you originally had them at, and you're going to buy those while they're low. That's how portfolio rebalancing works. It's kind of like dollar cost averaging, except you're doing it with your existing portfolio. And it's a super good way to maximize returns and minimize risk. Do you see why it minimizes risk? Because when oil goes way up like this, what's it going to do next? It's eventually going to go down. So you want to be taking some of that profit and putting it into something that went way down, because what went way down is going to eventually do what? Go back. Does it make sense? This is so simple. Warren Buffett said, investing is not like Olympic diving. You do not get extra points for difficulty. It's such a simple thing. These strategies make investing very simple if you'll just put them into practice. And you can put them into practice in your 401k. That's why I started off with the perfect investment. If you get a job with a corporation and they have a 401k and they match, you do that and you do everything I taught you today, you won't even have to try. It'll be like day one, you put all 5 of these into practice. The perfect investment, diversification, which is super easy if you just do some good asset allocation. And dollar cost averaging is going to happen automatically because the money that goes into your 401k comes out of your paycheck. And then the last one may require you to go push a button, or it may just be a check mark on that list. Some 401ks have automatic rebalancing. If you set that up when you're young, by the time you're my age, if you worked for a company for 5 years, 10 years, whatever, using these strategies in your 401k, you're going to build wealth. And if the market goes through major volatility, you don't need to worry about that. You just keep doing your plan. That's Investing 101 with the best strategies I know of to help you maximize returns and minimize risk. Any questions? Yes.
So when we invest, do we have to keep like rebalancing?
Yeah, you want to rebalance, but every quarter, every 6 months, you should put it on your calendar. Like I said, your 401k may have automatic rebalancing, but if it doesn't, you just go in, you log in. It's super easy. Once you log in and see how it works, there's a click, hit send, and it'll rebalance your portfolio. It's super easy to do. And if you don't know how to do it, somebody in HR will show you how to do it. But yeah, you want to do that on a regular basis. I would say quarterly or twice a year or at least once a year. Some people might do it monthly. That's depending on how volatile the market is, that might make sense. But typically, if you do it too frequently, it's not going to make any difference. It's not going to help that much, in other words. But if the market's very volatile, that's not true. If the market's going way up and way down, then rebalancing more frequently might give you a better result. But I wouldn't worry about it. I would just do it every quarter or twice a year.
And it's always getting bigger, the circle essentially.
Yeah, I mean that's the idea. And if you're dollar cost averaging, it's going to get bigger. Now, if you stop investing and just let it sit there, maybe not. It may get bigger and then get smaller, and that's what it'll do. Over time, though, it should get bigger. Everything over time goes up. Oil price over time goes up. The S&P 500 over time goes up. Bond values over time go up. So, I mean, every asset class you invest in, because of inflation, is going to eventually go up. But that doesn't mean you won't. You want to put these into practice because the market goes up and down, and that's how these strategies work. Any other questions? Yes.
And the profits, do you like take them out whenever you want? When that, like, let's say that I'm done like investing or whatever. Do you just take it out like at retirement?
So when do you take the profits out? So first of all, we stick to the 401k strategy because you're keeping that in there for retirement. So your profits always go back in to your account and get it reinvested in maybe a different asset class. Eventually, though, when you get to be my age and you're ready to retire and you quit your company, you stop working for that company, then that 401k account will get rolled into an IRA account. And that's what we're going to talk about next week. Different types of accounts, how they work, what they're designed for, which ones are better, and which ones you should be focused on moving forward. But your 401k is really just the account you're going to use to build your retirement while you work for a corporation. And remember, if you leave within 3 years, typically the vesting means you don't get the match if you leave that company within 3 years. So you don't want to switch companies. You'll lose your match if you switch companies within 3 years. Yes?
How do you, when you're making your portfolio and you're trying to determine the percentage to go into big caps, small cap, and whatnot, is that skewed towards what's going
No. You can Google that. It's a good question. How do you know what kind of asset allocation? And you can Google that. You can spend a lot of time trying to figure out, but it's going to boil down to what options do you have in your 401k to start with. And then, I would say if you're going to have US large cap, you're going to have international, you're going to have small cap, maybe you have mid cap if you're lucky, you're going to have bonds, you're probably going to have US bonds, you may have municipal bonds, you may have corporate bonds. So, you just look at all that and you go, okay, 25% each, 25% large, 25% small, 25% mid, 25% bond. And if you happen to have 3 different bond selections, you could divide those all up between the 25 you have for bonds. There's no way to do it. It's like slicing a pizza. And it's going to depend on what your options are. And when you see what options you have, it should be pretty easy. If you need some help, give me a call. I'm happy to look at your options and help you do it. But it's really something you want to do day one. And don't be afraid because you can always change it. U.S. large cap, 25, 25, 25 with bonds, large, small, and mid. And some international should go in there too. So that's 5 pieces. That's 20% each. You'll be fine. Okay? But you could say, I like large cap better and do that. That's where it starts to become like, okay, if you're working with an advisor, maybe you want to skew your allocation because something's going on out there. But typically that's not going to matter until you've got 100,000 or 500,000 or a couple million in your account. Then you do want to do that. But when you're just starting out, it doesn't really matter. It really doesn't. It's all about the way they move up and down. The more they do that, the better you're going to be because of dollar cost averaging and portfolio rebalancing. Okay? You guys have been a great audience. Thank you.
So Rebecca, I'm just gonna ask you one thing.
Yes.
Because I could not find, I turned in my assignment, but I could not find the week 8 quiz under week 8. Because it's usually right here.
You couldn't find what?
The quiz for week 8.
So when you do this, you're going to click over here. I love your computer. And you're going to go to this. And you're going to do the quiz.
This quiz?
Yeah, and then take a screenshot.
Okay.
Yep.
So we're
Did you-
doing Quizlet now.
Well, just every once in a while we do Quizlet.
Okay.
And that one, did you miss that?
Yeah.
I'll probably, what's your name?
Skylar.
Skylar. I'll try to give you grace.
Okay.
I'm sure other people
submit
missed it too.
right when I get back to my apartment.
Okay, good. Okay, cool. Thanks. Okay, I'm looking for questions in the chat, and I'm not seeing any
All right,
questions.
perfect. Thank you.
You bet. Take care. Have a good week.
Sir.
Jose, you still there? I was going to answer your question, but if you're not there, I'll pass. Okay, I'm going to end.